Hello, everyone, and welcome to the Nasdaq Dorsey Wright podcast for the week ending on August 12th. My name is Ian Saunders, and we're joined as well again today by Will Gibson. Will, it's good to be back in person. I know we took a week off. Had some slight vision issues last week that made me have to do the podcast from home, but it's good to be back in the office with you.
Yeah, definitely, and especially with everything that's going on, it's been nice to wheel over in my chair and ping you and see what you're thinking.
Yeah, and vice versa. And luckily, over the past week, it's been a lot of upside movement with a lot of stuff going on. We'll kick it off the same way we always do. There's been a lot of movement throughout the market over the course of the past week with the recurring 2022 intro that we have for this podcast. But we've seen a lot of improvement for a lot of the major indices. They've continued to push higher. Some kind of positive earnings reactions with some of the bigger names, continuing to push some of these bigger cap weighted indices higher, and leading some into levels that we might not have thought we would have gotten to this quickly. I mean, specifically for a lot of the time today, we'll probably be focusing around the Nasdaq 100. So looking at some of that tech heavy Nasdaq 100 movement, and then looking at movement for the NDX. I mean, we're out of a bear market, right? We're all blue skies from here on out, right?
I wish, yeah.
Yeah, that would be nice. But we did see that with movement this week, we did see the Nasdaq 100 officially move out of a bear market territory. And the way we're going to define bear market territory, obviously, there's different ways you can define bear markets. Like there's apparently different ways you can define inflation, right?
Or recession.
Or recessions, right? So just a lot of different ways to define different things. But we're going to look at the 20% decline as indicating a bear market for the Nasdaq 100, and then a subsequent 20% rally as ending that bear market period. Right now, there's been a lot of times throughout history that have seen 20% down, 20% back up, 20% back down, 20% back up. We'll get into some of that, but just for the sake of the conversation here, we're kind of looking towards that 20% down and 20% rally off of that bottom as kind of pinpointing that specific bear market period or bear market environment. And in looking at that, we got the 20% rally level. Actually did occur with movement this week, with movement on Wednesday, right? We saw that big push to the upside, with 2.8% rally in the Nasdaq 100 over the course of market action there on Wednesday, which brought us up to break out at a chart level of 13,500 or 13,400 rather. And pushing up with, at least at the time of this recording on Thursday, pushing up to a chart level of 13,500 on that 100-point chart there of NDX.
Yeah, and I think that 13.5 level is going to be a key place of resistance, and we're going to get into that some as well, and some of the individual names later that are also at some of these key levels. But I was watching June for a long time as your June level of resistance for that NASDAQ composite, which was back at 12,800. Positive, or excuse me, the negative trend line also around that place as well. Kind of blew through both of those, to be honest. We didn't see as much fight. We saw a ton of fight on Tuesday and yesterday with the S&P around 4,200. So we maybe would have expected to see a little bit more of a fight around June, but nonetheless kind of powered through, and you're getting to that 13.5 level of resistance now. Ian, you're mentioning before, looking ahead now, what else kind of faces the NASDAQ composite, or excuse me, NASDAQ 100, apart from that 13.5 level? You have 14.2 ahead of you, which is also the top or near the top of the trading band for the index. So that's a level that I think could be your next place to look towards for some type of test.
Yeah, absolutely. I mean, we're looking at kind of overhead resistance from here, like you said, breaking north of that 1300 mark, and breaking north of that June rally high. We're now with movement today, 13,500 sitting at some overhead resistance from May. Breaking through that would put you right up toward next resistance levels being at that 14,200, which also happens to correspond with the bullish price objective of the Nasdaq 100 on this 100-point chart. So the bullish price objective is something that can be helpful, can be not as helpful. It's most useful as a supplemental indicator, kind of more supplemental reading for different securities or indices in this case. And for those that might not be as familiar, it's just a strict rules-based system that when a security or an index or a name goes from a sell signal to a buy signal, it's then counting up the number of X's that are in that particular column when that signal changes on the point and figure chart, and then multiplying it by the box size, and then multiplying it by or adding it to the bottom X in that particular column. So really, it's just a way when signals change, when we get a movement from a sell signal to a buy signal on the chart, what's a realistic level that we could see this price movement kind of lead to further price movement down the road? Shouldn't be taken as the end all be all for price objective, but can be helpful in terms of understanding how a security or an index might move. So seeing that 14,200 match up with resistance, also match up with an heavily oversold or overbought condition rather for the Nasdaq 100. I mean, might give that level a little bit more weight.
Yeah, and I think in short, you say that it's just helpful to quantify the magnitude of a potential move or quantify the magnitude of that type of signal change that you've seen. So like Ian said, it's secondary or even tertiary really when you're looking at the technicals here, but it is cool to see it kind of line up with some resistance and the top of the trading band as well. I also wanted to kind of interject right here before we get maybe more into the typical behavior that you've seen from the Nasdaq 100 coming out of bear markets and around bear markets as a whole. Interesting note that the Nasdaq 100 in this case, in this particular environment, was one of the more beat up indices where you saw it offer a lot more shelter during like a 2020 environment bear market, not so much in 2022 where they took the brunt. Large cap growth, mega cap growth, tech discretionary just took the brunt end of a lot of things. So you've seen some extent when this was beginning, people were saying, is this some type of laggard bounce where it was a very technically weak area of the market bouncing out of heavily oversold territory? We're seeing some more evidence maybe that's not the case. One thing I'd like to mention is that you see risk assets typically do better coming out of bear markets, small caps being one of them, aggressive growth, or not so much aggressive growth, but more growthy offensive places of the market, and that's like 100 being one of those as well. So you are seeing some typical kind of coming out of bear market behavior where you're also seeing small caps do well right now. You're also seeing some of the other more offensive places doing well, which maybe gives this a bit more credit.
Yeah, and I mean that certainly kind of makes sense with you initially talking before. I mean, the Nasdaq 100 saw much more significant declines than a lot of other kind of broad market indices, and obviously it's very growth heavy, very tech heavy. Tech got beat up pretty bad with a lot of those growth oriented names, and makes sense with the expectations of further higher rate movements. You're going to see some of those valuations come down. You're going to see those names might get beat up a little bit more. But I guess the question everybody's kind of looking toward now is, we're getting too ahead of ourselves on the rally, right? Was this rally too quick in terms of kind of movement higher? Personally, I mean, I enjoy talking about rallies on the podcast. We come in here weekly, but it seems like we spent a lot of weeks there talking about negative movement.
Yeah. Oh yeah. A lot of mostly negative movement this year. And I think some stats that you had are really relevant because there's been a lot of talk about, are markets moving quicker now? Are we in this environment mainly attributed to quantitative easing and the Fed's involvement, but excluding that, are we in environments where you see quicker drawdowns, quicker rallies? And some of the stats that we were sharing before this would maybe say that this particular instance right here was actually towards the longer end, if I remember right, in terms of time to draw down and then the type of rally that we've seen so far.
Yeah. I mean, so in looking at history from the Nasdaq 100 since 1992, there have been a total of 11 bear market environments by that 20% down, 20% back up rule, 11 total bear market environments, not including the one that we're currently in. Now, the first one didn't come until 1998. We then saw 6 occur from 2000 to 2002. So a big cluster of times there where you saw 20% down, 20% back up, 40% down, 20% back up, 50% down, 20% back up, right? A lot of volatility in that kind of dot-com crash and post-crash environment. And then we saw 2 occur from 2007 to 2008, one in 2018, one in 2020, and then now we're in the 12th, the one that we're currently in here. And so the average decline of each of those, the average decline, peak to trough decline during those environments is about 36%. We got down to 33% in this decline. So I mean, it's not quite as bad as the others have been, but it's worse than others have been. About kind of on par with the average decline we typically see in the Nasdaq 100. The thing that you were touching on that we thought was pretty interesting is that took the Nasdaq 100 the second longest amount of time, second longest number of calendar days to get to that level. It took us 209 calendar days from peak to trough. Looking at the peak actually came in mid-November, November 19th was when that Nasdaq 100 peaked and then began to decline. And then ultimately ending that decline at the down mark, that 33% down really on June 16th of this year. which so 209 calendar days, the second most we've seen in any of those other 11 environments. The only other one that was longer, 243 calendar days that occurred from December 5th, 2001 to August 5th, 2002. Now, if you look at the 2000 to 2002 timeframe as one environment, that would be a different story, right? That's a much longer environment, but using that 20% down, 20% back up rule, I mean, we're kind of longer than it usually took for us to reach that level, and we saw about the same decline that we typically do.
Yeah, I think that was really interesting that it actually took us longer to get to, assuming this is a bottom. June 16th was what was the date that we've kind of been referencing for that bottom. So assuming that was the case, I found it really interesting that it actually took us longer, especially given a lot of the noise about market cycles are moving more quickly, bear markets, bull markets, rallies, sell-offs of the like. So I think that's a great data point to kind of have in your pocket for this instance. And then now looking at some of the image that we have on the screen right here, if you're looking on YouTube, and that Ian and I are both looking at, we put in our report earlier, but I think it's really interesting too that you put on this chart the trough to rally days. So not only how long does it take you to come down 20%, but how long does it take you to rally in pretty much all instances across the board by a wide margin, except for a couple. Your trough to rally, so the time it took you to regain was much shorter than the time it took you to fall.
Yeah.
And maybe we can attribute some of that to the upward bias of the market, meaning it typically pays to be a bull more than it does to be a bear. And you can see some of that here, some oversold conditions bouncing out. But any other thoughts or?
Yeah, I mean, we got to remember too, when you're declining from a peak to a trough 20%, and then you're moving 20% off of that, it's not going to be the same. So it makes sense that your 20% off the bottom isn't the same kind of value as your 20% off the top, right? So it makes sense it's going to be shorter on the rally than it would be on the decline. But it only took us 55 calendar days from the low in June through movement on Wednesday to hit that trough to rally point, which is really just kind of on par with what we've seen. I mean, it's usually around that kind of 50-day mark that it generally takes it. Obviously, in the 2002 environment, you got a lot more bear market environments kind of packed in there, so it took a shorter amount of time. But that 50-day mark is kind of par for the course in what we've seen from some of the other environments. So even though this, obviously, every environment feels very unique, right? But we're seeing a lot of the data kind of match up here with some of the other historical timeframes that we've seen, which I think is a pretty interesting point to note.
Yeah, there's a saying that especially goes around the technical analysis community a lot. It's that history doesn't repeat, but it often rhymes.
Yeah,
I think this is another prime example of that, and also an example of that. You never really get average in the market. You typically get well over or well under, and then it comes out to average. Whatever the market return is for the year, say for conversation's sake, it's 8% a year. It's a rare year that you actually get an 8% return. So similar to these types of things, kind of the averages will balance out. But in this case, it was pretty much right on.
Yeah.
That makes sense. Maybe we can start moving towards today, some of the names that were driving the Nasdaq 100 higher during this rally. It's a pretty well-known index. It's a pretty well-known basket of stocks within there. So a lot of household names. Apple was a big one of the biggest attributors to its performance.
Which makes sense. I mean, Apple's the most overweight, 13% of the Nasdaq 100. I mean, all the names you're looking at the top are, like you said, very household name oriented. I don't think anyone's going to be surprised or not heard of any of these top. You got Apple at 13% of, like, let's say the Qs, right? Yeah. Looking at the holdings of the Qs, Apple's 13%, Microsoft's 10.5%, Amazon's almost 7%. I mean, these are big market names and tech heavy names that have at least we get a lot of calls about when these have been moving higher.
Oh yeah, for sure. And some of the biggest names, I mean, I'm looking at the best performing stocks since June 16th bottom in the Nasdaq 100. Amazon made the top 10. It was at 9. Yep, Amazon made it to 9th in the top 10. The others.
What was number 1?
Number 1 was a company that I can't pronounce, but I'm going to give it my best. Mercado Libre.
Okay.
Mercado Libre. Someone's probably listening and saying I just butchered the name, and I'm sorry if you work for the company. Ticker MELI was the best performer, up 74%.
Wow, that's
over. Yeah. And then you had Moderna coming in 3rd, so that was up 44%. And then 5th was actually Netflix. Netflix stock was up almost 41%. since the bottom for the NDX. Interestingly, a lot of those stocks that are in your best performing basket were weak attribute names.
Which, I mean, I think that does, because those are names that fell off more.
Exactly.
I mean, you saw the Nasdaq 100, I mean, as we were talking about, was beat up much more than many of the other areas. And those weaker attribute names, and you saw some pretty sharply, almost crypto-like declines from some of those areas over the course of the first kind of 5 to 6 months of the year.
Oh yeah. Another big one that I was looking at was PayPal. That was another one of the biggest gainers over the past kind of trough to rally in the Nasdaq 100. Still a 2 attribute stock. Mentioned Netflix. That's still a 1 attribute stock right now. So these are still kind of weak names rallying out of heavily oversold, really beat up conditions. One that wasn't, like you mentioned, Amazon, one of the biggest weights. This recently moved back to high attribute territory, moved back to high attribute on July 29th. So well over, a month and a half after the NDX actually bottomed it. That makes sense. These are trend following momentum based ratings. So it does take some time for these things to come back.
Yeah. And I think another, I mean, out of the top 10 largest weightings within the Qs, 9 out of those top 10 are favorable attribute names, which is, I mean, a very different picture than we saw a few months ago.
Yeah.
Like you said, we've seen Amazon kind of show some improvement. Some others that kind of maintain favorable attribute ratings. I mean, those top areas, I mean, you're looking at Apple, right? Maintained a favorable attribute. It did move back to a 5 for 5 there in July, but it's maintained a favorable attribute. And it's maintained a buy signal against the market since 2004. So, I mean, very long-term relative strength winner, maintained a lot of long-term status. Getting a little bit frothy on that default chart. I mean, you're looking at a lot of these kind of big top heavy names, and the charts obviously look different because you've seen some different price movement, but you do see a lot of similarities that have started to kind of come into play. They're meeting some resistance levels. They're starting to get into the top of their trading bands. Could create some interesting movement over the course of the next few weeks.
Yeah, definitely, especially on Apple. I think that's probably your best visual of a chart. It's just a huge stem of X's all the way from 136 to 170, which is, like you said, at the top of the trading band. So I think it'll probably be healthy to see some exhales here for a lot of these stocks, for the indices as a whole to kind of take a breather. I know it's been said to me, a good analogy is if you're swimming or you're sprinting, big inhale, you got to take an exhale. And I think stocks can exhibit the same way. X is taking that big inhale, and then O is a nice exhale. Yeah. Sometimes you see a really big inhale followed by a pretty big exhale. So I wouldn't be too surprised, especially Apple, almost 100% overbought and matching some resistance. The other names, like you mentioned, are going to be in a pretty similar position as well.
Yeah, and I mean, you see, like you said, Apple's definitely probably the most kind of notable stem that you see. Some others, I mean, aren't as frothy, aren't as overbought. I mean, Microsoft's one that comes to mind. It's another strong 5 for 5 from an attribute standpoint. It's another name that's been a favorable attribute name for a while, right? It's at overhead resistance, also from April. So same there as Apple, but not nearly as kind of significant of a stem that we see. We generally, I mean, historically over the course of the past couple of years, just in following the price movement of Microsoft, it tends to show a little bit more kind of consistency there.
Yeah.
Consistent movement higher, and unfortunately kind of consistent movement lower recently, but it's not quite as frothy. So there's definitely some areas that you can kind of look toward, even though some areas are starting to meet some overhead resistance.
Yeah, and as a general note too, high momentum stocks will typically tend to be more overbought than other areas,
especially coming out of a bear market.
Especially they probably picked up a little bit of volatility when they were in the bear market. They've fortunately been able to use that to the upside lately. So all of that to be said, you're going to get some overbought readings, and typically good market or improving market environments, you get these pockets of froth or these kind of what we call broader market-wise, like breadth thrusts or beneath the surface, these stocks that bang up against the top of their trading band where they go on these huge stems. Typically, those are part of good markets. Of course, there's these bear market rally environments where they hit resistance and they fall off. But more often than not, I think that's probably a good thing for the longer term, just the near term dollar cost add-on pullbacks.
Yeah. I mean, it's a good thing to see stocks going up, right? And but continuing to kind of maintain those that maybe not jumping in kind of full position to Apple when it's up on such a significant stem. Because I mean, you look at Apple now, like we're talking about price level at 170, your initial support level is not coming in on the default chart until 134.
Yeah.
It's a pretty big drop. Right? I mean, that takes out almost all of this rally. So I mean, that's just kind of being cognizant of that. And recognizing these support levels. If you do see things pull back, it's going to better that kind of risk reward relationship and give you more kind of potentially more actionable territory to move into some of these securities as they're moving higher.
Definitely. And you can manipulate these chart scales, you make them really sensitive to show what you want to see. But like you said, at the end of the day, I think you're going to want to be objective here and don't let your eye deceive you too much. And I think there's some general indication that you can take from some of these moves here. Positive, a little frothy right now.
Yeah, definitely. Starting to get up there at least. So we've seen pockets of froth continue for weeks. I mean, we saw it in crude oil just as earlier this year, right? Overbought can very but quickly become more overbought. So it's not to say just because we're at these levels that you're going to see a pullback, it's time to sell, right? By no means. I mean, but because we're here, I mean, it might be prudent to at least kind of wait for a buy and pullback opportunity. We'll wait for those. If you're looking to add, you might get a more actionable, more better price than currently. Could be a good kind of takeaway to look toward.
Definitely.
Yeah.
Definitely. Well, Ian, that kind of wrapped up what I had on the docket today. Sparing any more comments. Maybe we can land the plane as we will for the podcast.
Yeah.
So thank you everybody for listening. We appreciate the feedback. We've also had some better feedback lately on Twitter, kind of putting out some of our thoughts and indicator moves throughout the day. So we are active on there as well if you want to see what we're thinking as well. YouTube, report, phone call, email, we're pretty accessible.
Yeah, we're here and more than happy to help. Obviously, I'm sure we're going to be circling back in the next couple of weeks. I mean, no shortage of movement that we're going to be happening. It's going to be happening over the course of the next few weeks here. But it's been great to get back doing these in person. Hopefully, we'll be able to continue that and get more positive feedback as the summer comes to an end here. It's hard to believe.
Yeah, I know. Mid-August is upon us.
It's very hot here in Richmond, so hopefully it's a little bit cooler wherever y'all are joining us from.
I heard there was a record that we were at least 7 degrees or higher for the longest time since like 20, 30 years or something.
Here in Richmond?
Like
wow.
Yeah. Don't quote me on that.
Hey, I mean, you heard it here on the podcast. You can quote them there. But
meteorologist will.
All right. No, but seriously, I hope everyone's kind of staying safe in this heat wave. And like Will said, if you have any kind of questions, comments, concerns, anything, we're here more than happy to help in this environment. So with that, I guess that kind of wraps up what we're looking to touch on here. So thanks everyone for joining us. We look forward to talking to you again next week.